Thank you, Alex, for reminding us that we need to record this. So you have said that you can have different classifications of ratios. And I'm saying that different books probably will classify them differently, irrespective of the books that you've um, read or what has been said. I may only classify this into probably 4, 5, or 6 different types of ratios. I will combine others for the sake of this class. But generally, we have what we call liquidity ratios, which we can also call working capital management ratios. We have liquidity ratios, which we can also call working capital management ratios. We also have what, number 2, we have solvency ratios. Solvency ratios, which can also be called long-term risk and capital structure ratios, right? You can also call them leverage, debt management ratios. Number 3, we have what we call operating efficiency or efficiency ratios. Efficiency ratios, we may have what we call efficiency ratios. And number 4, we have what we call profitability ratios. Profitability ratios, we have profitability ratios. We also have what we call investment ratios. We also have investment ratios. And we also have coverage ratios. Coverage ratios. Coverage ratios. Sorry, I keep on having a lot of interruption. Again, you'll have to excuse me. There are exams that are going on this week for those people who never sat for their end of January, April exam, and therefore it is important that we are able also to attend to that. Sorry, my friends. There are exams that are going on this week. Call them supplementary or special for those people who either failed in one or another, or if for those people who never did the exams, they were not in a position to. They were not in a position to sit for the exams. Therefore, we must be there also for them, and is likely to continue throughout the week. So probably you'll be interrupted also in other lessons, as the case may be. As the case may be. Now, we talked about the importance, and we have talked about the various types of ratios that are there. I said that classifications can be different. Different books will classify them differently. Brian, I'm here. How long will I take? I am here. I hope you're able to hear me. You can confirm that so that I don't talk to myself. Confirm that you're able to hear me. Can confirm that you're able to hear me. Thank you, Zainab. Thank you, Zainab. Good. So we continue, and I said that we start by looking at where is Leah? Can you come back to class? Leah, can you come back to class? Hello. Yes, we are in class. No, I wasn't. I was not presenting. I had taken a short break. For now, we are continuing. Okay. Oh my, a lot of interruptions today. Now we look at the short-term liquidity ratios, and under short-term, we can have what we say that these are liquidity ratios. Refers to, as I have said and put in the working space there, refers to an enterprise ability to meet its short-term debts as and when they fall due. And of course, a firm cannot meet its short-term obligations if the operation is not efficient. And therefore, a firm that is not able to meet that obligation is likely to go into liquidation or bankruptcy. Yeah? If they fail to pay their suppliers and creditors when they are supposed to pay them, then most likely they will go into liquidation. And this is the case for Uchumi Supermarket. This is what happened. Suppliers supply to you for 3 years and you have not paid them. Not a single penny. Where do you expect them to get money, more money to go and buy items so that they can supply those items to you? It becomes very difficult. And remember, most of the items, most of the products that supermarkets and the big malls and also wholesales deals with do not belong to them, right? They have procured them from their suppliers with an agreement that you give us 90 days or 60 days, as the case may be. We sell these items and then we pay you, right? Then we pay you. And therefore, it is critical that businesses like retail, supermarkets, and wholesale are able to meet and to pay off these debts when they are supposed to be paid. Otherwise, that was the case for the Uchumi. That is why it collapsed, because now the suppliers were not willing to continue supplying to them when they are not being paid. And unfortunately, I think the same case is happening to Tuskies. It is happening to Tuskies. Very unfortunate. But again, they have been having difficulties in paying their suppliers to the extent that the suppliers are saying, look here, we cannot continue supplying products to you and you're not paying us. Yeah, you're not paying us. And what happens next is, suppliers go to court and you are forced to pay them. You are forced to pay them, you are left without any working capital, right? And therefore, you're not able even to stock, or they are not willing to recommit themselves. Amongst the short-term liquidity ratios, we have what we call working capital ratio. We have working capital or working capital ratio. And this is simply gotten by subtracting current liabilities from the assets. And therefore, working capital is equals to current assets less current liabilities. Current assets less current liabilities. Current assets less current liabilities. And I want to hope that we still have we still have that PDF that I have sent. You can kindly check on that PDF and try to calculate that working capital. Try and calculate working capital for the years that are here. For the years that are here, we have 1999, 2000, and 2001. Can you calculate the working capital? Working capital. Calculate the working capital for those 3 years. Calculate working capital for those 3 years. Working capital, very fast. You can indicate it there in that public chart. Working capital, very fast, very fast. Good people, are we calculating these things? Working capital. $19.99, how much? $19.99, how much are you getting? Continue to 2000. Which PDF? Oh my. That is where we are. Is that PDF that was shared to all of us? Is in the group, Solomon. PDF is in the group. PDF is in the group. You should be able to find it there. If you don't have it, kindly ask one of your colleagues to send it to you. Kindly ask one of your colleagues to send it to you. So can we find for others? Year 2000, year 2001? year 2000, year 2001. Very fast, very fast. Mm-hmm. Year 2000 and thank you, thank you, thank you, Sarah. Zainab. Zainab. Sarah, thank you. Zainab, thank you. What are the others doing? What are the others doing? Now, can someone comment on, can someone make an observation? Can someone make an observation? Can someone make an observation? We need an observation. Someone make an observation on this. Very fast, very fast, very fast. Someone to make an observation on that. Someone to make an observation. The working capital has been increasing from 99 to 2001. Yes, that is a correct observation, Sarah. What do you think contributed to that? We've made an observation, we try to interpret very fast, very fast. What do you think was the major contributor to that? Someone who is interpreting that for us? Alex, say something. The increase in current assets. Someone is saying the increase in current assets is likely to have caused that. If you look at it closely, you notice that there's a bit of sharp increase in inventories and account receivables, to be specific. Yes, Sarah, it is important that you don't just mention the current assets, because if you look at the cash is declining. There's a decrease in cash, right? And therefore, that is a cause, because it could have been, again, the current liabilities decreasing. But in this case, there is no decrease. There is no decrease in the current assets. Oh my. Another interruption. Kindly, let me take this. We continue. So I was saying that this should have been, could have been brought by either a decrease in current liabilities, right? Or an increase in current assets, right? And therefore, even amongst the current assets, there could be different current assets that really led to a change or this increase in working capital. And therefore, here confidently we can say and conclude that it is the increase in receivables and inventory that has led to the increase in working capital management. That has led to increase in working capital management. And therefore, we can recommend that the company can continue working on the same or in the same trajectory. The other figure that we need to find out is the current ratio. Current ratio. And the current ratio, of course, also tests on short-term debt paying ability of an enterprise, right? It tests on short-term debt paying ability of an enterprise. This is because it measures the liquid and near liquid resources available to meet the short-term debts. A high current ratio, of course, is assumed to indicate strong liquidity position, and vice versa is true. Vice versa is true. That a low current ratio indicates a very weak liquidity positions. Was the rule of the thumb when it comes to current ratio is that the current assets should be twice current liabilities. Current assets should be twice the current liabilities. Of course, you calculate, this is not new to us. You calculate this current ratio is equals to current assets divided by current liability. Current assets divided by current liabilities. Or simply you can say current assets is to current assets to current liabilities. Current assets to current liabilities. And therefore, again, I refer you to the PDF so that you can compute that current assets, the current ratio, sorry. You can compute the current ratio and perhaps then make observation and interpret. Make observations and interpret that data. So can we calculate the current ratio? Current ratio. Current ratio. For 99. Very fast, very fast, very fast. You should be through with this. 3.89. For 1999, 5.37. Really? Brian, kindly check. Kindly check your figures. Why 5? Point 42 for year 2000. Why are we getting different figures? Let's see, 2001, 1.95, yes. 2000, 2.42, yes. Then for 2001, 0.42, 3.8. Yes, this is for 99. That's all right. That's all right. That's all right. Somebody to make an observation. Someone to make an observation. Very fast. What can you observe from those figures without thinking? Observation, you don't have to think. It's what you see. They are decreasing. Yeah, it's true. But the current ratio is decreasing. It is this, the current ratio is decreasing. And what is likely cause? What is the likely cause of this? Yeah, it's true, decreasing. What is the likely cause? What do you think has caused this? What do you think has caused this? Very fast, very fast. We need an explanation. We need to interpret those findings by looking now at the financial statements. The current ratio is it's true. It is true, Mohammed Omar. But what is the interpretation of this? What has caused it? For example, what is it that you think has caused this? Increase in current assets as current liabilities increase. No, that's not a proper explanation, my friend. Brian, that is not a proper explanation. There's an increase in assets. Current assets is current liabilities also increase. Accounts and notes payables have been increasing. Good trial, Sarah, but not quite. Can we give an explanation? Because even if they have been increasing, yes, but it's not only that is affecting the figure to decrease. Someone to give us a better explanation? Someone to give us. I told you that is the purpose of this course and unit. I know you've calculated these figures before, but your ability to interpret them, to make observation, analyze, and interpret. Increase in short-term debts. There's an increase in short-term debts. While cash decreases in the years. Good trial. But is the decrease in cash, the decrease in cash, is it able to have that big impact on all this? Is it able to have big impact on all this? Ah, yes, Alex, you got it. Got it. I hope we can see what Alex has written there, that the reason here is because there is a higher increase in liabilities than in current assets. If you look at them, all of them have been increasing, right? But the current liabilities are increasing at an increasing rate, right? Or they are increasing at a higher rate than the current assets. The current liabilities are increasing at a higher rate than the current assets. Increasing at an increasing rate than the current assets. Now, the way you interpret this, or the way it can be useful is that we advise that the company needs to investigate the cause of increase in current liabilities, and especially the increase in accounts and notes payables. They need to do further investigation to know what is making them to have that sharp increase, and that has led them to affecting the ratio. Remember, the ideal ratio should be 2:1, right? And currently we are seeing that it has gone from 3.8 to below 2. So it is a cause of concern. It should worry the enterprise, and therefore further investigations need to be done to curb the increase in notes and accounts payables. Notes and accounts payable. Of course, if the increase is related to the stock that we have here, then they need to ensure that they are able to move the stock very fast, or also collect the account receivables very fast. I hope that is clear. I hope that is clear. Remember, I said the interpretation part is what is key. The interpretation part is what is key in this unit. It is what is key in this unit. Good. From there, we can calculate the quick ratio. Quick ratio. The quick ratio simply is current assets less inventories less prepayments divided by current liabilities. Say that quick ratio or acid test ratio will be equal to current assets less inventories and less current liabilities. Sorry, current assets less inventory less prepayment divided by current liabilities. So can you find out, can you calculate that figure? Can you calculate that figure? Can you calculate that very fast? Very fast, very fast. 1.9, yes. So now, 1.91. That is for 99, eh? For year 2000, yeah, 2000, 0.95, yes. For 2001, for 2001, 2001, 2001, 0.7, 0.7, 0.7. Can we get an observation? An observation? Yes, Alex, it's 0.7. An observation, there's a decrease in acid test in quick ratio. That is an observation. That is true. There is a decrease. There is a decrease. Somebody to interpret that. Someone to interpret that for us. Can someone interpret that for us? Tell us the likely cause. Yeah, that is a true observation. Leaky decreases over the years. It is decreasing. The trend is worrying. What is the likely cause? What is the likely cause? Is the likely cause? Companies' current assets are highly dependent on inventory. Good trial. can be interpreted that the general ability of the business to pay off its debts when they fall due is decreasing since most of its current assets are tied up in inventory. Most of its current assets are tied up. Good trial. The higher the current assets, the higher the. Yeah, this is true, but is it an explanation? I want an explanation. I need an explanation on this. Statement, it can be interpreted that the general ability of the business to pay off its debt has been falling. The company does not have enough liquid assets to pay their current liabilities. Can we say that? To some extent, yes, there's a decrease in that ability. There's a decrease in that ability. But my question is, what is it that has caused that? What is it that has caused that? And we cannot talk about inventory here. True or false? Can we talk about inventory? Let's see. Let us see. Tied up in inventory. Pay off the debts, decrease in current liabilities. When the current liabilities decrease, are they decreasing? From the statement that I sent you, are they decreasing? Is there a decrease in current liabilities? I'm seeing different things. Current liabilities have gone from 49 to 107 to 202. So they are not decreasing, they are not increasing. They are not decreasing, they are increasing. Let me see. There's a decrease in ratio because these companies are unable to meet the short term because the current liabilities are increasing with the years. Now, there are two possible explanations. One is that there is a sharp increase in current liabilities, right? There is a huge increase or sharp increase in current liability. Or number two, you can also say that there's an explanation that Alex had given. Is it Alex? Yeah, most of its current assets are tied up in the inventories, right? And therefore, inventory represents a huge part of the current assets. And therefore, that is why that, again, ratio is declining. There's been a sharp increase, again, in inventories. Remember, you're supposed to subtract the inventories, right? You're supposed to subtract the inventory. And therefore, we can recommend that they need to do what? What do they need to do to rectify the situation? Is to move inventories faster. And when it comes to movement of inventory, it could probably mean that they should sell more on credit. I hope these things are making sense. I hope these things are making sense. And again, also to reduce the current liabilities, they should try to pay up the debts as and then they fall due. Yeah, Zainab, it is true. Probably liability is also being paid off quickly. I don't know, maybe. There's a decrease in ratio because therefore the company is unable to meet its short-term liabilities. The current liabilities are increasing. Yes. The current assets other than inventory are increasing at a lower rate compared to the, yeah, that's a perfect explanation, Alex. Now, what we are doing now is what we call analysis, right? This is what we call analysis. Yes, Alex, that is spot on. That is spot on. This is what we call analysis. It is what we call analysis, and therefore it is important for the company again now to go a step further and investigate why that increase in inventory, or why the inventories are increasing at a lower rate. The current assets are increasing at a lower rate than they need to investigate that. Once they are able to know the reason, then they rectify. They rectify the situation. They rectify the situation. Now, I want to hope that we are able to get that trend. We can do one more for account receivables. Account receivables and account receivable turnover ratio, maybe. We see what it entails. Account receivable turnover ratio. And this is a ratio that measures the number of times an enterprise has turned account receivables into cash during a year. It is a ratio that measures the number of times an enterprise has turned account receivables into cash during a year. Of course, it will measure the efficiency of collection, right? How quickly are you able to collect once you sell on credit? How quickly are you able to collect once you sell on credit? Account receivables turnover is gotten by dividing credit sales by average trade receivables. In our case, I am not sure whether we have credit sales. Do we? Do we have credit sales? Yes, all of them were on credit. So we have that. So can we calculate that? Can we calculate that? Can we calculate that at least? Let us calculate that, and then probably we call it a day. Yes, we have said that we have said that account receivable turnover, account receivables turnover ratio is equals to credit sales divided by average trade receivables, divided by average trade receivables. Average trade receivables. Average trade receivables. Average trade receivables. So can we calculate that? Is it possible from the figures that we have? Is it possible from the figures that we have? Very fast, very fast. Let me see this. 827 divided by 8320. 10.29, it's correct, Brian, or 10.3. Next, for year 2000, year 2000, 9.77, correct, correct. 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 6.62. Correct. Correct. Someone to make an observation? Someone to make an observation. Someone to make an observation. There is a decrease. There seems to be a decrease. Yes. What is the likely cause of that decrease? What is the likely cause of the decrease? Likely cause of the decrease? Someone very fast. The likely cause of the decrease. Very fast, very fast. The likely cause, account receivables increase at a higher rate than credit sales. Spot on, spot on. But that is an explanation. It's the analysis that you have done. Eh? Yeah. It's true. There is a decrease. That is, there is a Mohammed Omar. You got it correctly when you see that the observation is that there is a decrease, right? But now the explanation here given by Brian is also correct, because it says the account receivables increase at a higher rate than the credit sales. If you see that trend in credit sales, they are not, the increase is not as good. It is not as that one for, it is not as good as that one for account receivables, right? And therefore, again, we need to look at the sales. We need to look at the credit sales. What is happening with the sales? When the company is investing in all this, increasing the trade receivable, the receivables, the stock, the inventory is increasing, but the sales, credit sales seem to be slugging. Is it the terms that we have as a company or as a business that are not favorable to our suppliers out there? Right? Is it the terms that are there? Is it the discounts that we need to pursue or to look at? Is it the supply? Is it the after-sales service that we need to look at? No, that is where it will lead us. Once we start interpreting, that is where it will lead us. I want to believe that we are now able to do the observation part and the interpretation or analysis, because that is the key for this topic. That is the key for this topic and this unit. Now, due to time constraints, I think I will wish to stop there. I know there has been a lot of disturbances today, but kindly also ensure that you are able to calculate this and put it here so that we get it. The age of the inventory, age of the inventory, age of the inventory, or average sales ratio, average sales ratio. also calculate the inventory turnover ratio. Inventory turnover ratio. I think that would be the subject of discussion. That is where you should paste this. And let me create the discussion here. That is where that should be calculated. Create a forum. So that should mark the end of my live presentation, right? We do the rest. I've already posted them in the forum. So let us do that there. Thank you.